Our next guest is going to teach us how to invest in real estate in San Diego. Please welcome Realtor from Century 21, Steve Ploetz.
Welcome back, Smarter San Diego. There he is, Steve Ploetz. How are you, my friend?
Hey, how's it going? How's it going? Good to be here.
Well, excellent.
Let's do something interesting. Want to talk about something interesting?
I would love to talk about interesting.
Let's make it interesting.
Let's go right into something interesting. You've talked a lot about real estate investing in the past. Tell me a little bit. What do we need to know?
I have in the past. Right now, too. You know, it's fun stuff. It is, especially if you have, if you're not stupid.
And there you have it, ladies and gentlemen.
Wait a minute. I'm not Steve. You're Steve.
Wait a second.
You're Steve.
That's right.
I'm Derrick.
Oh.
We need to switch.
All right,
hold on. Boom. Oh. There it is. All right, good. Whew. Feels, it was weird.
Yeah,
there.
It feels better now.
This feels right. So, Steve, thank you for coming in today, first of all. I think now's a really hard time to invest in San Diego real estate. And I know you're a type of guy who will shoot us straight here. But tell me how all the people out there who are even having trouble buying their own homes to live in can plot the course to potentially actually become an investor and own real estate that they can rent out or flip or whatever.
Yeah, and I think that exactly as you've alluded to, the biggest challenge is that you're competing with owner-occupied buyers. You're competing with buyers that are purchasing for a roof over their head, and as we've talked about numerous times, people are buying that on how it makes them feel and emotion and all these things that are not price per square foot and are not investment pieces. So I think that as an investor, whether it's a first time or it's something that you've done many, many times, you need to be very strict about your guidelines and very strict about what are the things that you're willing and unwilling to do. And it may take more offers than you're comfortable with in order to actually crack into one. So how do you do it? A variety of different ways. Number one is you need to identify the correct types of sellers. As we've talked about, there are sellers that price is very important, but it's not the most important thing. Trust sales where somebody has passed away and there's 3 different trustees that are all over the United States. They want to sell that property and they want to sell it at a good price, but most importantly, they want to sell it. And so they want to be done with it. And so if you have the ability in order to say, look, I'm already been pre-approved, I can close this out, I can do short contingencies, I know what I'm looking for, I've already seen the property, I can waive some contingencies up front, not recommending that you do that, but all of those things will help get you a foot in the door. So that's a place to start, and then certainly from there is identifying the types of properties that you want, the types of tenants that you want, and make some decisions from there. So which opens up a huge conversation, which is...
Yeah, well, first of all, just like right now, early 2017 in San Diego, prices have been going up for like 5-6 straight years.
Right.
So, as an investor, do you have to wait for the right time? Like, do you need to now be timing? Because we're talking about buying residential real estate, for roof over your head, it really doesn't matter. If you're going to live there for the long term, let's say 10 plus years, it doesn't matter. You don't have to look at the market. But as an investor now, do I have to pay attention to that? Do I have to look and go, well, the market's a little higher, now maybe I should wait? Or how do you navigate that element of the now?
Well, and so I can only speak from my own personal experience, which is the investing that my wife and I have done, is we look for 2 main criteria. One is appreciation, and the other is cash flow. If it only has one of those criteria, we're not interested. Gotcha. If I'm making $100 a month, but overall in the long term this doesn't become a good investment, I'm not interested. If I'm losing $250 per month on it, it's not a good investment in my opinion. And so what we look for is a 6% return. If I invest $100,000, I want to make $6,000 that year, because otherwise most people have a mortgage, and that mortgage comes with an interest rate. So that interest rate for us is around 4%. If I'm not getting 4%, I might as well put that money in my mortgage and pay down my principal, because there I'm getting that return on that money. So the short answer is, I don't think that there is specifically an ability to time the market, but I do think that you can do what you can on the front end to protect yourself and make sure that you're walking into some equity. It may not be as big as it has been in the past, but multiple offer situations are at least helpful to know there's other people that are interested in this property, so if I won out and beat them out by $5,000, maybe they would be willing to come up in another month or two. And then the big thing to me is the cash flow. Crunching the numbers and figuring out not only principal, interest, taxes, insurance, but HOAs, vacancies. How long is the property going to sit vacant, and what does that cost me as the investor? What do I need to fix up? How much is that going to cost me? So that you look at it from a dollar and cents kind of situation, whereas the average typical homeowner that buys a house, they look at their monthly payment. And then they're surprised by supplemental tax bill. They're surprised by the work that needs to go into the property, those types of things, and that screws up all your numbers.
Yeah, you have to, now when you're saying 6%, are you saying including all like maintenance costs and everything?
Vacancies, everything. That's what I want. And so certainly, and that's optimistic, especially in this marketplace where we're talking about probably every realtor you've had on here is talking about multiple offers, very limited inventory, blah, blah, blah. It does make it more challenging. So it has to pencil. Because if it doesn't pencil, it doesn't make sense in any way, shape, or form to all of a sudden jump into a market that is hot with the expectation that, hey, I'll ride it out. I don't care if I'm losing money every month. In the end, it's going to be a great investment and I'll be able to sell it in a couple years. That's a bad way to jump in.
So you need income and appreciation to feel good about it. What about vacation renting? I mean, is that the property type that people should be looking for? Because that would be considered to be income side.
Correct. Yeah, like VRBO or Airbnb. I think there's some challenges with that. Typically, those types of properties need to be in specific neighborhoods. If I live in Kansas and I'm coming to San Diego, I live in Vista. I love Vista. I'm probably not coming to live in Vista. If I'm going to come out here for a week, I want to go to all the coastal communities. I want to go to Carlsbad, Encinitas, Del Mar, Solana Beach, La Jolla, downtown, all of those places where there's stuff going on. And those price points have become extremely competitive and could make an argument for some of those price points are a little overinflated. So is it a good investment? Maybe. I think it's a case-by-case situation, but when you look at those neighborhoods overall, they don't pencil.
So maybe more risk, but potentially more reward.
Potentially, yes.
If things continue to go the way they have.
And so here's my big thought of it. If you're buying an investment and you need to say that, if things continue to go the way they're going, it's a bad investment. You don't want that.
Yeah, you need it to be safer than that.
You want to be something that you step into today and you say, hey, look, I don't know what's going to happen to the market. However, here's what I do know. I'm walking into equity some today. I'm walking into cash flow today. These things I can control. So if you're not walking into that and you're hoping if everything continues, if this market continues, then you're not a savvy investor. Then anybody can become an investor. Just buy a house.
Yeah. Well, I think that one of the things that's turned me off on the vacation rental side of things is just that I feel like a lot of these properties that are vacation rentable have it already priced in. It's already priced in that they're going to have, more income, and so then you go and you're buying a place based on that, but you're not really getting that equity. That seller is getting that equity from you. You're having to pay for that equity. And now if you lose that for some reason, heaven forbid, citywide rule changes, or like in Del Mar, they outlawed it basically.
Right.
Then all of a sudden you just lost big time. So setting yourself up for less of that, more upside, right? That's what you're talking about. You want to set yourself up for more upside. Like I don't want to have to say, oh, well, if this happens, then it's a good investment. No, you want to set yourself up for this, a lot of upside. So in a tight market like this then, how do I approach this? I mean, is it literally just a numbers game where I'm gonna have to say, okay, hey, Steve, I've saved up some money. I already own my own home. I want to invest in more real estate. Do I just need to be in, do I have to write 100 offers? Do I have to stare at the real estate market every day? How do I get ahead in such a competitive situation?
Well, and I think that you can work backwards a little bit and you can figure out probably what you're going to want to do is start small. You're going to want to start with a, a 1 bedroom, a 2 bedroom, maybe a condo, maybe something that's more affordable in a lower price point, and recognize what are the demographics that you're going to rent to. if you're near the military base, potentially you've got military clientele. If you're in a smaller place, maybe that's a young professional. If you've got a one or two bedroom, you're probably not renting to a family. And so understanding the demographics as well and the advantages and disadvantages of each demographic. Students are great in that mom and dad oftentimes co-sign, but the downside is they only want to be there for 9 months. Usually they don't want to have a rental where they're there June, July, and August because they're out of school and they'd rather go home or do other things. So identifying who the demographic is as well will also help you work backwards. So then you can figure out, okay, I've got a 1 or 2 bedroom. Who likely would this property rent to, and what can I command and rent, and then work the other way.
Okay, I got it. So you kind of have to begin with the end in mind, essentially.
Begin with the end in mind.
Okay, fantastic stuff. Great advice. Is there any other advice that you would have for potentially a new investor out there who's getting cracking right now?
Well, I think that it's worth it to take a look at it, because as an investment class, I mean, all we hear about in the financial world is diversify your portfolio, and hey, don't be entirely in residential real estate, don't be entirely in mutual funds, don't be entirely in all these different places. What I love about it is it's a great diversification to have potentially through the equity proposition where I'm paying myself the equity over time because I'm leveraging and I'm putting 25% down and getting in. Using all that equity, I think all of that is really helpful. Here's what I mean. I didn't explain that very well, so let me describe it. Let's use $100,000 just because that's a round number. You certainly wouldn't need $100,000 to invest into real estate, but that's a great way to start. If I have $100,000 and I want to buy in the stock market, and I discover I want to buy UPS, and it's trading at $100 a share, I can buy 1,000 shares of UPS. Or if I buy in residential real estate because of leveraging, I can take $100,000 and I can put 25% down, and now I'm buying a $400,000 house. So in both situations, if the market jumps 10%, my UPS shares have gone from $100 a share to $110 a share, and I make $10,000, where my $400,000 house goes to $440,000. Same appreciation amount, however, it impacts me greater because I'm able to leverage. And so that's the benefit, in my opinion, of residential real estate, or all real estate, is the ability to leverage.
Great stuff, Steve. Thank you so much for your time today. Really
Thank you,
appreciate
Steve, or Derrick.
Stick around for more Smarter San Diego TV, where we guarantee to make you smarter than everyone else, commercial free.